The housing market has certainly cooled dramatically this fall. Some say it's frozen before winter.
Well, U.S. household debt increased by 2% in the second quarter, topping over $16 trillion. That's according to the New York Federal Reserve Bank.
As the U.S. economy continues to recover from the impact of the pandemic, millions of Americans are worried about the state of the housing market. According to a recent study, 58% of respondents expressed their very or fairly concerned about a possible housing market crash the next 12 months. The study further revealed that factors such as rising home prices, low inventory, and high competition among buyers contribute to potential home buyers' anxiety. Such concerns have led many to rethink their home buying plans or to explore alternative options, such as renting or relocating to more affordable areas. In this video, we'll uncover 10 reasons that make the housing market crash closer than we think. But before moving to the first point, consider subscribing to the channel and hitting the notification bell. That way, you'll always be informed on America's most important economic topics. Thank you. Now, let's get back to the topic. Number 1. Skyrocketing mortgage rates. The selling of already built homes has witnessed a continued decline, reaching levels last observed during the aftermath of the Great Recession. Despite this, prices have remained high and not budged, even with mortgage rates being at their highest in 23 years. The National Association of Realtors has reported that the sales of existing homes in October have fallen below economists' predictions, totaling 3.79 million. In the same month, the median price witnessed a slight increase, reaching $391,000, a 3.4% rise from the last year, but a 6.3% drop from September. The average rate on a 30-year fixed-rate mortgage reached 7.79% in late October, the highest since November 2000, according to Freddie Mac. U.S. mortgage rates are expected to be higher than previously forecasted in the upcoming year. Despite elevated borrowing costs, home prices are also projected to increase. Previously, the forecast for rates at the end of 2024 was 6.8%, but now it stands at 7.1%. By the end of 2025, rates are predicted to decrease slightly to 6.6%. Number 2. Rising household debt. The New York Fed's quarterly report on household debt and credit has revealed some concerning trends in the United States. According to the report, household debt in the country has increased by a staggering $228 billion in the third quarter of 2023, bringing the total amount of debt owed to an all-time high of $17.3 trillion, at least in nominal terms. This increase has been primarily driven by mounting balances in mortgage, credit card, and student loan accounts, which are causing financial strain on many households across the country. Consumer credit reports increased by $126 billion during the third quarter of 2023, reached a total of $12.1 trillion by the end of September. Additionally, balances on home equity lines of credit, HELOC, increased by $9 billion, bringing the total HELOC balance to almost $350 billion American dollars. Number 3. Economic recession. The housing market is highly sensitive to the overall state of the economy. When the economy experiences a downturn, it can have a ripple effect on the housing market, leading to job losses, reduced income, and increased foreclosures. These factors can put downward pressure on home prices and make it more difficult for people to buy or sell homes. According to Deutsche Bank analysts, there are signs that the U.S. may experience a mild recession in the first half of 2024. This is based on softening economic data, which suggests that the economic growth rate may slow down in the coming years. If this happens, it could have a negative impact on the housing market, making it even harder for people to navigate the real estate landscape. Number 4. Rising interest rates. Rising interest rates can reduce the number of potential home buyers, leading to a sharp decline in home prices. The U.S. Federal Reserve's decision to keep interest rates steady at a 22-year high could discourage potential home buyers due to higher mortgage costs, leading to a decline in home prices. Despite inflation reaching its highest level in a generation, Chairman Jerome Powell cautioned that there could be further rate hikes in the future. Fed aims to balance containing inflation and supporting economic growth by maintaining its benchmark federal funds rate at 5.25% to 5.5%. Number 5. High inflation. Inflation in housing has been one of the main contributors to the housing crisis. Just a decade ago, the average sales price of houses sold in the United States was $334,000, while now it is well over $500,000. Millions of families simply cannot afford a home in this economy. But the main problem is that there is no short-term solution. In the aftermath of the great financial crisis, the average price per square foot of floor space in new single-family housing in the United States experienced a downturn. This was followed by a number of years of stagnation as the housing market struggled to regain its footing. However, since 2012, the price per square foot has seen a steady increase, a current rate of $168 per square foot as of 2022. Number 6. Housing market bubble. The housing market is a complex system that's influenced by various factors, including supply and demand, interest rates, and speculation. When speculation drives rapid increases in home prices, it can create a bubble that eventually bursts, leading to a market correction. This correction can result in a significant drop in home prices, which can have a ripple effect on the economy. Unfortunately, experts are not optimistic about the current state of the housing market, as it bears a striking resemblance to the conditions that led to the 2008 financial crisis. The high levels of speculation and the unsustainable rise in home prices are causing concern among economists and policymakers alike. Number 7. Financial market crisis. The impact of financial market instability can be far-reaching, affecting not only the stock market and banking sector, but also consumer confidence and the housing market. Recently, 2 major regional banks in the U.S., namely Silicon Valley Bank, based in California, and Signature Bank in New York, have crumbled under the weight of significant losses on their bond portfolios and a massive run on deposits. These 2 banks are the largest to fail in the U.S. since the collapse of Washington Mutual in 2008, which had assets worth around $309 billion at the time, compared to SVB's $209 billion. The collapse of these banks is a stark reminder of the fragility of the financial system and the need for robust risk management practices. Number 8. Tightening lending standards. During the second quarter, U.S. banks have reported weaker loan demand from both consumers and businesses, along with tighter credit standards. While strict lending standards may seem like a good move to prevent losses, it can limit access to mortgages, causing a reduction in demand and putting downward pressure on housing prices. Federal Reserve survey data highlights the importance of striking a balance between risk management and ensuring access to credit. According to the latest data, over 33% of domestic banks are tightening standards for commercial and industrial loans to large and middle market firms. Number 9. Consumer confidence. During tough economic times, consumers tend to cut back on their spending, which can have a ripple effect on the economy as a whole. In September, consumer confidence in the United States hit a 4-month low due to the concerns about rising prices and the possibility of a recession. Unsurprisingly, the Commerce Department reported that new home sales dropped by 8.7% in August to a seasonally adjusted annual rate of 675,000 units, following a surge to a 17-month high in July. Many consumers have raised concerns regarding the political situation and the increase in interest rates. It is worth noting that the decline in consumer confidence has affected all householders aged 35 and above. It's not limited to any specific income group. Number 10. Foreclosures. Foreclosure rates have increased this quarter as indicated by the latest data. Foreclosure starts, which are primarily responsible for this trend, have almost returned to pre-pandemic levels since the federal government lifted a moratorium on the most foreclosure filings. The rise in foreclosures might also be due to pending filings that are financially being processed. Despite the national, some economic upswing and job stability, it's evident that some homeowners are still struggling with the financial aftermath of the pandemic or facing new challenges. Report indicates that there were a total of over 100,000 U.S. properties that underwent foreclosure filings, including default notices, scheduled auctions, or bank repossessions. This represents a 3% increase from the previous quarter and a 9% increase from the same period last year.